In this video, I'd like to talk about how to model a home sale during retirement or take a reverse mortgage. So I've clicked on the our favorite Todd and Sylvia Young case, and all of this is done in the retirement analysis area. And what we're going to do is we are going to create a new asset that represents the home sale. So I'm going to come in here, and typically I think it's going to end up being taxable. In other words, once this home is sold, what type of asset are we going to put it in? Probably going to be taxable. I do add, probably joint, and then we get to decide on the type of asset that it's going to be. I'm just going to pick a CD. We'll put this with Fidelity, and the balance is 0 because we haven't sold the home yet. And then we got a projected rate of return. I'm going to give it 4.5%. Okay, now we've got that in here. So there is our CD. And the way we get money in or out of a particular asset is via events. So we're going to create an event for this asset. Again, this is the events for the CD. And this is the home sale. We're going to sell the house for $250,000. And the thing is we're not selling it in this year. When are we selling the house? That's the start and end year. So I'm going to take a look at this age chart and just take a quick glance. You'll see this age chart throughout the app. Very handy for finding out when people are certain ages. Let's go ahead and sell it in 2040 when Todd is 75 years old. All right, so we go to 2040. 2040 is also the end year because we're not doing this over more than a year. Certainly no annual increase, and there we go. So notice we had 5 years up here. I don't know if you happen to see that, and now it's at 2 years. Again, because we just got $250,000 that we didn't have before. We also kind of assume that, where are Todd and Sylvia living? Let's say they're living with a son or daughter, because certainly there'd be an expense somewhere. So that's how I model the home sale. And then I can go, if I wanted to see more detail on that, of course I can go to the results and the asset detail. And there is the CD right here. Now again, important, there is no beginning balance because it doesn't have one right now. There is no balance at retirement because we actually added money to it after we were retired. That's why that 0, we gave it 4.5%, and it earns some interest for us. So let's talk real quick about a reverse mortgage and what you would do there. Really simple. Reverse mortgage is simply, again, as I call it, money that comes out of thin air. That's an income stream. So I'm going to do an add other income, and it's going to be joint. The type is miscellaneous, and the source of the income, I don't know who does reverse mortgages, but we'll call it Wells Fargo, whoever our company is. And let's say we're going to get $1,100 a month, and that is monthly. I don't know if reverse mortgages have an annual increase. They might. Let's say it has a 2% annual increase, and that again is going to start in year, let's make it 2042. We just sold the house in 2040, and that's going to go for, actually what we could do is we could give it to Todd and then hit that button, and that actually defaults this to the owner's retirement years. So we still don't want to start it in 2030. We'll start it in 2042, and it'll go through Todd's life expectancy, 2046. Maybe Sylvia wants it. We'll have it go through 2048. Again, this is all for you to end up deciding, and we'll make that joint. Hit OK, and again, remember we were 2 years, so that changed a little bit in there because we're getting $1,000 a month. So that's how you model a reverse mortgage. Please take a look at the other videos that I've got on the support page. They'll greatly help you in learning the ins and outs of IncomeMax. Thanks for your time.